Welcome back to the Biz Beat by SVA, where we break down the tax and business topics that business owners and leaders need to know. I'm Lee Schwartz, Director of Business Development and Sales here at SVA Certified Public Accountants, and joined, as almost always, by Eric Trost, our firm's president and tax principal. Eric, you were gone all last week. How was Disney?
Yeah, I did two things last week. I was in Disney for a couple days with the family, and that's always a good time. We really enjoy it down there. And then I also did my golf vacation,
Oh,
and
is that
so
that's a
met some
guy's
guys down
vacation?
there and golf for 5 days in a row.
5 days in a row. And how'd you hit him?
Um, in the words of Ty Webb from Caddyshack, I'm not good.
Well, you're probably better than me if it makes you feel any better. Well, we had Ted Heidinger sit in last week. He did a great job of talking a little bit about some of the things to be thinking about if you're a real estate professional or an owner of real estate. Some things we've kind of touched on before, but we're going to get back into our typical go of it. But just before we jump in, a reminder, if you are tracking changes related to OBA, the One Big Beautiful Bill Act, we still have that hub up on our website, sva.com/OBA, 3Bs. It's your one-stop shop for all sorts of information and resources and past webinars so that you can stay up to date on what has changed, especially now that we are in tax planning season. But Eric, there was a lot that happened while you were gone. It wasn't all Disney related. One of the big news of the week was the Fed rate cut. You want to talk a little bit about what they decided last week and maybe some thoughts on where that's going?
Yeah, so the Fed cut rates again, not without controversy. So there was another that they call 25 basis point cuts, or in the lingo, if you want to know the lingo of what these finance guys use, they call them bips or basis points. So 25 bips. So you want to start smart, you start throwing that bips word around.
Okay.
But anyway, what they did is they cut rates 0.25%. Which tends to have a lowering effect then on business loans, on mortgage rates. And in fact, mortgage rates are down. If you look year over year, mortgage rates are down about 0.5%. They're still in the sixes for a 30-year. But that tends to drive interest rates down, which the hope is, or the thought is, that does spur the economy. It increases spending because the cost of funds is going lower.
So what do you think is on the horizon here? I mean, there's been near constant talk about what's the Fed going to do, and then they announce what they're going to do, but then there's another meeting coming up. So where's kind of the general consensus, if there is any? What's the thought on where this is going in the future?
Yeah, there was a consensus. If you go back a couple months, I think there was more of a consensus that the rates were going to be cut, not only these 25 bips, but another 25 basis points at the next meeting. So the next meeting's in December. It's their last meeting of the year. And the thought was back in December, they were going to have like 3 rate cuts. So they've had 2 so far. There was some consensus that there'd be 3. So there'd be another one in December. That's a little less likely now. I personally think it's still going to happen, but I wouldn't say it's a consensus anymore, because there's some outliers that vote on this that have said, hey, that's we're starting to cut to a point where we're concerned about inflation. So that's the other side of it. The lower these rates go, the cheaper funds get. That spurs more spending. That can create inflation. And I would think that what their concern is we're not out of the woods yet on inflation, still running 2 to 3% or higher than 3%. And so is that low enough that we can still cut rates? I think that's what they're going to be thinking. And we're going into, Christmas season or holiday season. So there's going to be some spending likely going on there. What happens with these rate cuts going into the spending season? That might be a concern. And do they hold off on the cut? I think that's got some chance. I still think, though, that ultimately, if I had to bet, they're going to cut rates one more time, 25 basis points.
Okay, and that's just over a month away. So, Eric, if you're a business owner right now, you're thinking about a big investment. Talk to your bank, see what they think. But
Sure.
But any other thoughts that a business owner should be thinking about?
Yeah, I think for business owners, it is communication with your banker right now and just making sure that as your renewals are coming up, are you timing them out right? What's likely not going to happen is the rates aren't going to go up. So it's likely either stay the same or come down. And the same with mortgage rates. And so are you considering, say, refinancing? Let's say you've got a higher rate than, let's say it's around 7% you bought in the last couple of years and you're up near seven. Once it goes down a point, it makes sense to take a look at refinancing and, redoing your mortgage at that lower rate, even though it costs you some, that interest point savings can be quite a bit of savings over the course of time. So this is a time you're starting to look at that and say, okay, what are my loans? What are my cost of funds? Do I have loans renewing right now? And what kind of rate should I be expecting?
Yeah, all good things to think about, but more news to come. We will keep you up to speed. Our next topic is going to be one we've touched on a couple of times already here on the podcast, Eric, but some new guidance coming out from the IRS last week on the employee retention credit. So they just released some new FAQs. Can you walk our listeners through what those FAQs say and what business owners need to know?
Yeah, so this is probably the IRS's last word on the ERC or the employee retention credit. Back when OBA was passed, it's part of the rules in OBA was any credit claim filed after January 31st, 2024 was not going to be processed. And so some folks actually had theirs processed and they got their refunds. And one of the questions is, well, what happens if I got my refund, but I filed after January 31st, 2024? Do I get to keep this refund? Do I have to send it back? The FAQs, which is frequently asked questions, address this and say you don't have to send it back. So you can keep that refund. Otherwise, what they talked about is just clarification that that is indeed the rule. And if you file late or filed after January 31st, 2024, and your claim hasn't been processed, it's not going to be. And if you file right now and say, well, maybe I can still get this ERC credit out there, it's not going to be processed. So they wanted to make clear that that is indeed the rule. However, if your claim was processed prior to these frequently asked questions coming out, even I guess anytime after you filed it, if you filed it January 31st, 2024 or after, and it was processed by the IRS, you don't have to send the money back.
Okay. Well, speaking of sending the money back, I know we've talked a little bit about some of these sort of aggressive uh, promoters, I guess, of the ERC. Um, we know there were firms out there who were being more aggressive than they should have about encouraging companies who really didn't qualify to apply.
Right.
So, any update there, or is it sort of stay the course as far as what you've talked about before, which is, hey, if reevaluate that, and if something doesn't pass the smell test, it might be time to look at that.
Yeah, I think it's still stay the course. There's been a promise by the IRS that they're going to look at these. Now, I have seen no evidence that they've started any audit procedures on these. They could, though. They believe that there's been some abuse here from some of those aggressive promoters, so they could at any time. Whether they get to it or not, that's a question. I mean, I go back to the days of the PPP, and at one time, that was the Payroll Protection Program, which was part of the COVID Act in 2020, I mean. And the SBA was essentially in charge of giving these loans out. And at some point, the SBA said, hey, if you're taking these loans and you shouldn't have taken these loans, we're going to start auditing you. Actually, that never really came to fruition. I think when they figured out what the workload was and what their resources were to do this, they essentially dropped it. So they talked about it for a while, but they never got around to it. The same could be with these ERCs. You don't know. The IRS could be saying, hey, we're going to get to this and we intend to audit it. And maybe they intend to, but at the end of the day, do they have the resources? Recall right now, we're still down on a shutdown. There's many IRS agents that aren't even working right now. So they're having a hard time just keeping up with whatever day to day operations they are tasked with. I'm not sure how they get this program together and start auditing these ERCs. So I don't want to say it's not coming for sure, but right now I just find it difficult to believe that they're going to be able to allocate resources to do these audits anytime soon.
Right. Yeah, it seems like between all the staffing, I guess, shortages, we've talked about that in previous podcasts about what percentage the IRS is down now with the shutdown. Boy, it would be tough for them to take a big look at this, I would think.
Yeah, it's tough for them. Like I said, even to get, if you get a notice from the IRS and say, well, I'm just going to call them and take care of it, it's not an easy task because you're going to
Right.
have a hard time getting through to a human on the other end.
Absolutely. I feel like that's really true for any place anymore, to try and get a human, except
Hey,
here
hey,
at
not
FBA,
us.
everybody.
We answer our phones by ourselves
Exactly.
here.
Exactly. There you go. Great minds think alike. So, Eric, let's jump into this week's mailbag questions. So, we had a similar, these are sort of sister questions. One that we had a couple of weeks ago was about the difference between tax credit and tax deduction. This one is similar. Before we get into it, I just want to remind everybody you can send your questions to bizbeat@sva.com or drop it on our website at sva.com/bizbeat. So, Eric, the question is, what is the difference between an above the line deduction and a below the line deduction?
Right. So in each case, we're talking about deductions. So things that would be allowed as a deduction, like real estate taxes, gambling losses, hobby losses to the extent of income, charitable contributions. So those are tax deductions. Below the line deduction, those fall into what's called your itemized deductions. So itemized deductions are a category of deductions. They occur below the line. It means the below the line of your gross income. And when you have a below the line deduction, you add up all these below the line deductions and you get to compare it to your standard deduction. So, standard deduction for a married couple is about $30,000. You compare all these below the line deductions to that standard deduction and you take whatever's higher. And so, below the line deductions only mean something if in total they add up to more than your standard deduction. And a lot of folks don't use anything but the standard deduction. So their below the line deductions don't affect their tax liability at all. They don't reduce their tax liability at all. Above the line deductions are better. Above the line deductions mean you get those deductions before even looking at your itemized or standard deduction. So above the line deductions always reduce your taxable income. For example, one of the above the line deductions is the new charitable contribution rules that allow up to a couple $1,000s of charitable contribution, cash contributions. That's a new rule for charitable contributions. It occurs above the line, which means you get that deduction whether or not you itemize your deductions. There's not many above the line deductions, but there are some. For example, your self employed health insurance deduction, if you're an S Corporation shareholder and taking health insurance. There's retirement plan deductions that are above the line for if you run your own business as what's called a sole proprietor or Schedule C. So there's a number of above the line deductions that you don't have to take into account, itemized and total and standard deductions. You just get to deduct those. And then the other deductions that are below the line, those are within your itemized deductions. That means you have to add all those up and compare it to the standard deduction. Sometimes those make a difference for you, and sometimes they do not. So, bottom line, above the line deductions, those are the best things you're looking for. Below the line deductions, they're still deductions, but they may not have an impact on your tax liability.
Right. And as you think about your client base, I mean, these are generally people with complex tax needs or business owners. I mean, are some of them even still taking the
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 standard
minimum,
deduction?
yeah, the standard deduction?
I got you, Lee. Don't
Yeah.
worry.
Sorry. Thank
I
you.
know what
See?
you were trying to say.
Yeah.
So, yeah, a number of them do take the standard deduction. Part of it is because the itemized deductions, some of those are limited. For example, in the past, there was a limitation of $10,000 on your state and local taxes. That's moved to $40,000 now. So there's a number of clients that we service that do take that standard deduction. One of the things to look at, this is an interesting one, is with gambling losses. That's really a below the line deduction. So you could have gambling winnings, and you might say, well, great, I'll take my gambling losses up to my gambling winnings, and I won't pay any tax on that. That's not necessarily true because gambling losses are deductions that occur below the line unless you have what's called same day losses. This is if you have a lot of gambling winnings and you want to get your gambling deductions, loss deductions above the line, you have to use what's called a same day loss rule. So that's maybe a topic for another show, but you want to take a look at that if you're a gambler because it can move your deduction from below the line, which is where you got to compare it and add it to your itemized deductions and compare it to the standard deduction. You move it from below the line to above the line, where it definitely impacts, i.e., lowers your tax liability.
I think that is an interesting topic. I would imagine it probably applies to very few of our listeners, but I would also bet that they would find it really interesting, as I would as well. Let's put
Don't underestimate the draw of some of the casinos in the areas.
that's for sure. Anyway, okay, that wraps up this week's episode of the Biz Beat by SVA. Make sure to subscribe on Apple Podcasts, on Spotify, or on YouTube. And don't forget to check out sva.com/OBA for the latest updates, information, past webinars, all that good stuff. And as always, remember, information here is just meant to be general in nature. It's not meant to be specific advice for you in your situation. But I will tell you, it's November. It is prime tax planning season. So if you're not working with an advisor to talk to you about what's happening in your tax world, now would be the time. Reach out to us if you don't already work with us, and we'll talk about how to make you a client. Thanks for listening, and we look forward to seeing you next week on The Biz Beat by SVA.
It's the Biz Beat by SVA, breaking down the news of the day. From tax tips to business trends, smart insights from trusted friends. The Biz Beat.